Hello, Baker MBA finance students. Hope everyone had a good weekend. We are just about wrapping up week 6, going to get everything finished up for that. In week 7, you're going to read chapters 16, 17, and 18. Deals quite a bit with debt policy, debt theory. You're going to look at dividend policy, and then also wrap up in 18 with kind of long-term financial planning, especially if I have needs for raising some type of capital in the future. If I'm a growing company, I may have to put a plug in place and then figure out in the long term, how am I going to raise that capital. So there's different techniques I can use. So with the forum discussion this week, I have it tied directly to help you with your project. So I want you to talk about your company's dividends, the most recent dividend it paid. I think I own some money in Great Plains Energy, and I think it pays like 23.5 cents every quarter. Maybe it's 24 cents now, but tell me a little bit about when the ex-dividend date was, what was the dividend amount, also whether you are believe that it's paying a good dividend policy, is it kind of in line with what the management thinks it should be doing. And then describe a little bit about the your company's debt. How much is it leveraging itself? Is it in line with the industry averages? So make that post earlier in the week. I know we have Thanksgiving coming up here, so try to get this week finished early as far as your post. That way you can relax the coming weekend, enjoy the rest of the holiday week. So, all right, let me go into a little bit more details about the chapters this week, specifically starting off with Chapter 16, Debt Policy. You're going to first look at a little bit of theory in finance with Bonellini and Miller. And what they're saying, these guys are saying that it really shouldn't matter in efficient markets, and if there's not tax implications, that how you structure the company is not going to increase the company's value. You should not be willing to pay more for a share stock price just based on whether they have less debt or more debt. It should really be based on what value does this company have, what potential cash flow can they generate for the future. How you finance the company shouldn't matter. But later they recognize that markets are not perfect and taxes do play a role. So a company can experience financial distress, or they could actually magnify their returns too if things are going well. So in that sense, the level of debt does impact the potential value of the firm. And that's where the market tries to analyze that. And in a way, the market will tell you how much debt you can take on too. There are ratings agencies that, like Moody's and S&Ps, that will start to kick in maybe that financial distress, and it could devalue the company if they feel you have too much debt and can't handle it. They mentioned some other things in this chapter. They mentioned about operating business risk, like just the everyday, whether people want your product or not, or something changes in the market, or management is not doing something well, or if there's a change in demand for the product. Say Oprah says, don't eat this anymore. That could have a big impact. I think right now, sugar is really under attack in a lot of the food industries. Probably for good reason sugar should be under attack, because we have a lot of diabetes problems in the world. But cereal manufacturers have to be more cognizant now about how much sugar is in their cereal, because mom's going to be looking at that now. So those are examples like changes in demand or operating risk. But financial risk ties in my ability to pay back. If you take out loans personally, something happens to you, lose your job, it's going to be a little bit difficult to pay those loans down. So how much leverage you have, how much debt relative to your equity, puts you at a little bit more risk if you stop having those cash flows come in. And one thing they kind of wrap up with in this chapter too is the interest tax shield. One of the big benefits for corporations, at least, to take out debt is it lowers their opportunity cost as capital, just as we saw back with the weighted average cost of capital. So it can kind of in ways magnify the returns to the shareholders, what I like to call the spoons. That if I have more debt outstanding, I have fewer spoons, the shareholders, that if things go well, I can magnify those returns to the shareholders. So, and lastly, kind of tying in with the chapter 16 and the debt, look at your company's debt. What are the long-term bonds that they have issued? What is the rate of return on those? Is that interest rates could be going up here in a couple of months. So, the borrowing costs could be going up for some of these companies too, depending on their ability to pay back their debt. It's something when I was at Sprint, I would always be concerned looking at, what is my borrowing cost relative to the risk-free rate, government rate, or my peers. So that kind of told me when interest rates change, which many people believe the Fed is going to do here in the next couple of months, I would want to track that, want to know how much my borrowing costs are going to go up to, either short-term or long-term. Okay, well, so some other things we want to look at here. Chapter 17, with the payout policy, and this kind of ties into your forum discussion. They talk about the technical procedures of paying out a dividend, the ex-dividend date. That's put in place to kind of give the back office some time to clarify who actually owns that share of stock, so the transfer can be made properly. And thinking about, when a dividend is paid out, and I remember when I was in the corporate world, and I was responsible for sending the wire to UMB Bank, and I'd send a wire for like $100 million, and then it kind of went out like a shotgun effect electronically to everyone that owned that dividend. So hardly any dividends are paid by an actual check this day. You must have all done electronically. But there are other options that companies have too, that they can decide to perhaps issue more shares of stock. They can also do stock splits as another option. Now again, stock splits in theory should not change the value of the firm, but there's usually sometimes that managers like to have the share price just trade at a certain level. The idea that if I split it and it's now lower and it's more attractive, increased demand, that just doesn't jive in fundamental finance. It's again, investors should not be willing to pay more. They should be able to recognize and see through that. And then obviously there are tax decisions relative to dividends and capital gains. I still believe that capital gains and dividends are at a 15% rate, but if that does change, that should change management's philosophy about whether they want to give a capital gain in the share price appreciation or whether they should pay out dividends. Lastly, in Chapter 18, looks a little bit of long-term financial planning. Usually this is where you want to gather information from different departments to try to create a model. You get all the inputs to create a model, and then you have some outputs, such as pro forma statements. So just as we looked in previous chapters, you'd want to look at sensitivity analysis, scenario analysis, but you're trying to project out your financing needs for, say, a 5-year time period or longer. And, if you're in a growth stage, you're going to have to figure out some way to generate more capital. You're going to need more money. There's going to be a limitation based on how much I pay out to my shareholders in forms of dividends, how much do I keep in retained earnings. Well, this chapter is going to talk about a sustainable growth rate, and it's also going to talk about the amount of money you would have to go out. We may have to put in a plug for a time period, and then later figure out where we're going to find this money from. So that's where you're going to hear things about sustainable growth rate, plugs, and trying to project out. And when we're looking in the crystal ball, nothing is guaranteed, but it is important to have plans, especially if you do want to grow your company. I know at where I work at my university, we do have plans for growth. There are certain things we're trying to put in place in terms of investments. This does cost money. This does require increase in endowments, fundraising, and also potentially issuing some more debt. We just have to be careful with our debt levels too, to make sure it's balanced, and we got to figure out how we're going to raise this capital if we want to grow our student population. So, well, that was it for this week. I want you all to have a great Thanksgiving. We'll have that week off. I'll try to get the stuff graded from week 7 fairly quickly, but do take the time off. I'm going to try to avoid jumping into Moodle too often during our weekly break. I may just check it once in a while, but I will have one last video lecture for week 8 and tell you about the exam and all that. We'll wrap everything up. Otherwise, have a great week, and you all take care.